Well, we have the market certainly thinking that it was going to be enjoying a bit of an upswing this week. What are you making of the kind of turnaround we've seen on the NSE?
The market, hi Alicia. The market is definitely reversing some of the gains seen over the last couple of days. Basically, we're seeing some water trading in overall market movements, particularly regarding the banks. Yesterday's major movers were small caps, most of the way when you're looking at movement above the 3%, 4% mark. In terms of the larger cap stocks, particularly the banks and the major FMCGs, we saw sideways trading by and large. And it's interesting looking at those volatility figures because in the half year to June, we saw the volatility, even though it's structured by the 5% trading regulation, but volatility in the half year to June was at about the 0.8% mark on a daily average. In the month of August, it has trended downwards to the plus minus 0.45%. So giving some indication of the fact that there's a treading water situation, as I said.
Well, common topic at the desk has been around investors' interest in emerging and frontier markets amidst an uncertain global picture. And amongst that, Nigeria sits. Just how susceptible has the NSE become to fluctuations in the global economy? Because we know that foreign participation on this index is quite significant.
The NSE index has a float of a certain percentage that does relate to announcements and movement and international macroeconomic flows, but by and large it is driven by local liquidity drivers, and these have been trending upwards, and that's why we're in positive territory overall. However, there are strong micro-based factors that are holding back some of the sort of more bullish participants in the market. Again, we have to refer to the banks. The banks make up over 40% of capitalization, and banks' capital market subsidiaries trade significantly. These subsidiaries are awaiting offloading opportunities to be able to fall in line with CBN regulations about holding only 10% in capital market investment instruments and things like that.
So if we look at valuations, sorry to interrupt, really. But seeing that you are on the banking sector, if we're looking at valuations there, we've got Nigerian banks currently trading at an average price to book of 1.2 times relative to banks in other emerging frontier market peers such as Brazil, which is trading at over 2 times. We've got Kenya at 1.78 times. What are you making of the current valuations here? Because while, yes, it may look cheap on the face of it, we are looking at a sector that's surrounded by quite a bit of unease still.
Yeah, well, those figures just bear the full indicators of the risk facets of pricing, as well as the comparative macroeconomic perceptions about the direction of those territories. It's interesting that 3 years ago we were also looking at banks in the wake of consolidation and the initial spell of capital raising, also trading at very attractive price to book situations, and one or two analysts wondered why there was value that was not being heeded. To some extent, we found out why that was. I mean, not to suggest that there's another spate of revelations to come, but it's just a reflection of some of the risk facets inherent in in the valuations. However, there is of course investment opportunities in the short, medium, and long term, given the low PEs.
While there may be those opportunities on the basis that we are looking at low PEs, improved growth in top line numbers is exactly what the market is after at this point in time, especially as we approach the third quarter earnings season. So what are your expectations on that front after the kind of half-year results we've seen come to the fore?
Yeah, well, it's more of the same in a nutshell. We've seen, basically, we remember that the CBN's Monetary Policy Committee noted that credit to the public sector annualized would grow, suggested growth of up to 120%. And this shows that there is gross earnings activity, top line activity taking place with the banks. And of course there are the sectors like the exposure to the oil and gas sector and the telecom sector, which have shown resilient operational activities. And the top 6 or 7 banks, including the likes of Zenith, First Bank, GT Bank, and UBA, are quietly but resiliently continuing their exposure to these sectors, and that explains the top line growth. So more of the same, low double-digit growth when the next results come through.
Funso, as we wrap up here, just looking at the trading day ahead, what have you got your eye on specifically today, and what kind of market activity are you expecting to come to the fore in today's trading session?
I expect activity, like I said, there are value vessels, so to speak, with the banks. One would expect that market participants will be going overweight with the likes of Diamond Bank and Fidelity Bank. At the same time, amongst real sector stocks, the flour millers have been posting very good, strong double-digit profit growth as they move into more sort of value-added retail products, pasta and the like, which gives them better margins. Flour mills is of course the sector bellwether. However, it is sort of unwieldy when it comes to operations and finances because of its exposure to port activities and cement and the like. So one would look at activity in sort of the second rung of the flour millers. Dangote flour has shown that I think Honeywell flour will reflect some of the tremendous trading and price activity that Dangote flour has. Beyond that, O&O is a regular investor torch, so to speak, and at a PEG that is well under 1 and a forward PE that is well under 10, I expect that O&O's latest interims will continue to attract.
Of course, that has been a firm favorite amongst many of the brokers that we speak to on the show. We're going